I'm Gianna. I'm Gianna, and today I'll be presenting to you some crucial financial skills you will need as an investor. So next slide. So these will be what we will be covering for my presentation. So the first half of my presentation will be mostly focused on stock market and index fund. And then we'll be having a quick 5-minute break before I proceed to discussing brokerages, securities accounts, and savings accounts. So next slide, please. So the first option we have as an investor is the stock market. So next slide. So when we say the term, I bought a stock, we just say that you bought ownership in a company. So you invested your money in a company. So stock is the ownership of a corporation. So that company you invested in is able to grow because you invested your money towards its growth. So in this scenario, the company made a profit and so did you because the stock rises up as the company grows. Along with a solid business plan, any business needs capital to rapidly grow and expand its operations. So just think about how companies such as Walmart, Amazon, and Apple were able to grow so rapidly. So it was due to your money that you invested in these businesses. So now a share is a unit to measure ownership. So each share has a different measurement. So for example, for Apple, a share is worth $128, while for Twitter, a share is worth $54. So don't get these two terms mixed up. So now it does not necessarily mean that a costly share represents a higher worth company, as companies often split their stock to make it more affordable. So this means that if one share previously was for $500, then now 5 shares would be $500. So as per the market itself, it is just a ground where money is traded. So for example, when a lot of people buy a stock, its price increases. Conversely, when a lot of people sell a stock, its price decreases, which makes it a money trading ground. So in the modern day, you would probably buy your stocks using an online brokerage. So a brokerage is merely the mandatory middleman between your purchase and the stock exchange. So the stock exchange is the place where stocks are listed. Usually each country has at least one stock exchange where companies that are registered under that country can list their stock for the public to buy. Next slide, please. So buying and selling is usually the simplest way to describe how the stock market operates. So you simply buy a stock in which you get a microscopic amount of equity and ownership in a business, and the business uses your money to grow their operations. So selling is a bit more complicated than buying. So when selling, you usually sell that ownership for a profit. So with selling, there are two sides. So you have the buyer and the seller. So just like in any store that you visit, the store, who's the seller, gives you the product and you pay the cash. Similarly, in stocks, there are two sides. So we have the buyer and the seller. So in this case, the seller must sell its stock and the buyer must give money to its broker to buy the stock. So the stock market is a fast-paced setting. So these purchases happen within seconds. So usually you will always find a buyer and a seller. However, in the rare case, the SEC, which is the Securities and Exchange Commission, gives usually 3 days for the sellers to deliver the stock certificate and the buyer to get the purchase money. Previously, the SEC gave you 5 days, but now due to technological advancements, such trades are a lot more fast-paced. Next slide, please. Short selling, a very interesting concept to grasp. So in short words, this means that you will profit off a company's loss. So an investor's profit off the drop of a share. But how does this happen? So basically, the investor borrows a security and immediately sells it on the open market with the plan to put it back later. So now let me tell you a real life scenario. So let's say I have this container which costs like $2. So my friend also has this container and I want to borrow it from him. Now I immediately sell this container to someone else for $2. So in this case, I did not actually own the container. So I sold my friend's container. So that means I still have to give it back to him, and I am short of a container. So a week later, due to high supply and low demand, the price of a container drops down to $1.50. I buy the container back at $1.50 and give it to my friends. So in this case, I just made 50 cents by betting on the decreasing cost of a container. Similarly, in stocks, you borrow a company's shares, put it on out in the market, and buy it back later at a lower cost to make a profit. Now, the scenario above, where I sell this container to another person, all happens within seconds via brokerage. So all you need to focus on is the decreasing share of various companies. That is all your concern. Your brokerage handles the back end. So in short words, you make profit when the price is reduced and a loss when the price is raised. Next slide, please. So there are actually two types of stocks that you can buy. So you have the common and the preferred stock. So these work in parallel directions. So a common stock represents ownership in a corporation. With a common stock, you get voting rights for the board of directors. Wow, imagine having the privilege to vote for someone like Sundar Pichai to be the CEO of Google. So it all happens when you get ownership of a company. However, as fun and exciting as this sounds, you're probably the last person to get a payout if the company sinks under and closes its operations. So you most likely won't be able to get your investment back. So with a common stock, you also get this thing known as dividends. So think of dividends as an incentive you get to continue holding on to to the share. So the company pays you a piece of their profit every quarter. So if you want to unmute yourselves or type in the chat, so what a quarter is, and a hint, it's not 25 cents. So yeah, so the company gives you a quarterly dividend for holding onto the share. And usually this is 1 to 5% of the value of the share at the given quarter. So every quarter, if a stock is priced out at $100 consistently for the year, you can earn $5 every quarter, which sums up to $20 every year just to hold on to the stock. Now, tech stocks don't usually give out dividends, and this is because they soar very high. Their prices increase exponentially, so they don't need to give out quarters because their stock already performs well. Preferred stocks are kind of like opposite of common stocks. Although they represent ownership in a corporation, with a preferred stock, you're the first to get the payout. However, you don't get any voting rights for the board of directors of a company. You have to pay a premium for your preferred stocks. Now, when you search up, let's say, when you search up your company plus stock price, you would get the value of the common stock. For preferred stocks, you pay a premium because you are one of the first people to get a payout if the company sinks under or shuts down. So your investment is protected. Along with this, you also get a preferred claim on assets. Next slide, please. So entering the market as a teen is a bit complicated than it seems. So the minimum age to make a stock trade is 18 and above. So as a teen, your choices are left to get a custodial account in which your parents will have a full control regarding the investment decisions you make. Or you can use your parents' account and advise them regarding these stocks. If nothing works out, then just practice and learn. So in this age, we have the medium of technology to teach us basically anything. So if you're interested, then learn to prepare yourself. So when you're able to trade, then you have the skills to do so. Next slide, please. So the next option you have as an investor is index funds. Next slide, please. So index funds are an interesting type of investment to cover. So in fact, a survey shows that most Americans are uncomfortable with the term index funds when it comes to the most talked about financial terms. So basically, index funds are a type of mutual fund or exchange traded fund. They also offer ownership in a wide array of stocks rather than just one stock. This offers immediate diversification. So the word index means a portfolio of stocks and bonds, and index funds mimic the financial market index. So if anyone can type in the chat box, who here can give an example of a financial market index? I'll be waiting for your answers in the chat box. Oh, okay. Who here can give an example of a financial market index? Okay, I'll give a clue. It starts with the letter S and has 500 at the end. Yeah. Yes, you're right. So a very popular example is the S&P 500, which shows the performance and are composed of the largest 500 companies in the USA. So now a financial market index is presented to give the investor a general overview of how the markets are doing. So a significant rise or decrease in the fund, such as the S&P 500, conveys that there may be a bull, which means profitable, or a bear, declining season coming up. So one cannot actually invest in a financial market index. So that is where they use index funds, which mimic the financial market index. So these index funds are run by companies and are known to be a source of passive income because they are not actively managed, hence the lower expense and fees. So that is a lot to take in. So if everyone can just write how they are feeling about this topic right now, and if there's anything I need to go through again. Yeah. Okay, I think we have a question in the chat box. What about the FTSE 100 index? Yes, so of um, it's a type of financial market index. So I think it's, if I'm not mistaken, it's for London. Yes. Okay. I think since no one is, I think I will assume that everyone is okay with the topic. So, okay, I think we can move on. Oh, okay. Okay, Malik says that he's excited to learn and know about this because it's generalized and understood since we are going to study about this soon. Oh, that's nice. Is it only for London? Yes, I think so. I think FTSE is only for London. It's yeah, it shows only, like, it represents the 100 companies listed on the London Stock Exchange. Yes. No problem. So yeah, I think I can move on. So almost every financial market index has an index fund. So just like, for example, the FTSE 100 index, which represents the London financial market. So there are various companies who sell these index funds. And when you invest in one, you need to make sure that you are investing with the right company. So I will be explaining this further with this topic. So the index funds that you can buy are EFTs, so which are exchange traded funds. So you can buy and sell these anytime during market hours, just like stocks. EFTs basically follows index funds and they track their prices. So this does not have to be the price, but it's more so on the movement. So you can also buy index funds through your brokerage. but they do not allow you to trade throughout the day. Next slide, please. So now there is a key investment mindset that index funds feed off. And this is passive investment strategy, which means that you don't have to watch or touch your investment at all. So you just let your money work for you and come back in a few decades with a very steep return. So now, obviously, this is a positive scenario, which is not always realistic. A lot of investors like to follow. Main difference funds is that index funds thrive on the theory that over time, the market will beat the majority of funds managed by a person or a team in returns. So essentially, the market all. But is this theory true? Well, studies have shown that over long time periods, the market has beaten most actively managed funds. But looking short term, mutual funds tend to beat the market a lot more. So before choosing your investment, you really have to consider your investment horizon and whether you want to wait 30 years to get the best return, or if you want to have a more short term approach. So we always recommend a long term investment mindset for teens as we are advantageous when it comes to the time we have. Next slide, please. So, as always, investments have pros and cons, and although index funds are great, there are some downsides. So let's start out with the pros. So as we mentioned, index funds boast very low fees and also have very low tax exposure, which may not seem like a big deal. But when it comes to investment taxes, the sum can be pretty great. So there is also a proven theory that over time, passive management tends to outperform, and the built-in diversification, which is great for risk management. So now let's get to the cons of index funds. So first, there is no downside protection. So for example, if your investment loses money, there's no one who can control it and try to shift your investments. So you're just stuck until the market goes up again. So index funds aren't also able to take advantage of emerging opportunities as it just sticks with the same investments. So it also cannot lose stocks that are weighing the portfolio down. And all of this is due to lack of professional management. So while passive management strategies are beneficial, there are also some downsides. Next slide, please. So in conclusion, index funds and stocks are very popular investment options and are really great investments. So both have their different features, pros and cons. So it's important to do your research before making an investment. Next slide, please. So let's test your knowledge. So please type your answers in the chat box or feel free to unmute. So my first question is, why are index funds different from mutual funds? So if you could type your answers in the chat box or feel free to unmute. Sorry, I don't think I heard you, but can you feel free? Can you unmute right now? If you can. Yes, hello.
Yeah, hi. So what I believe is that in mutual funds is that the investment, the changing the list of securities. But just as you said about the index funds, like it's the S&P 500 500, it's listed for specific companies. Like also for the London CSET, it's listed for specific companies only in London. So it's depending from that to like differentiate.
Yes, you're definitely right. Thank you for that. Okay, Kasham says index funds invest in a specific list of securities like the S&P 500 and listed companies only. So index funds are not actively managed. Yes, you're right. Okay, so yeah, index funds thrive on the theory that over time, the market will beat the majority of funds managed by a person or team in returns. So essentially, the market always wins. Okay, thank you, everyone. So for the second question, do preferred stocks give you voting rights? Yes or no? So a while ago, we discussed about preferred stocks and common stocks. And so, yeah, the question is, do preferred stocks give you voting rights? Okay, calling on the others. Okay, thank you so much for those who answered. So the answer is no. So only common stocks give you voting rights. Okay, next. What is one of the most popular indexes? Clue, it starts with the letter S and has 500. Yeah. Okay. Okay, I see correct answers in the chat box. Yes, S&P 500. And the last question, how many days does the SEC give to the seller to deliver the stock certificate? Do you guys want a clue? Okay, it's in its range is like from 1 to 5 days. Yeah. Choose one number between 1 to 5. 3. Yes, you're right. So the SEC gives 3 days to the seller to deliver the stock certificate. Okay. All right. You guys are on a roll. Thank you so much for answering and engaging with me. So with that, we will be taking a 5-minute break. See you.
Yeah, okay, great. Thank you so much, Yana. So I'm going to be playing some music and then we can continue after our short break. Okay, everyone. So now we will be resuming with the rest of our presentation. So I'm going to continue sharing my screen, and Gianna, feel free to get started.
Okay, thank you so much, Armira. So now that you've learned about two exciting investments, you're probably very eager to start, but don't know how. Well, now we are going to go over about how to actually open an investing account and start your investment journey, even as someone who is under the age of 18. Next slide, please. So, what are brokerage accounts? So, a brokerage account is what most investors use to buy and sell securities like stocks, bonds, and mutual funds. So, as a beginner, I wondered, can't I just go onto a company's website and purchase some stocks? Unfortunately, as I've come to learn, this is not the case. So, brokerage accounts are facilitated through brokerage firms, which are companies or institutions that aid in the buying and selling of stocks and other investments. So brokerages essentially work as the middleman between companies and your purchasing investments. Next slide, please. So to further our knowledge on what brokerage accounts are, we need to understand how they are used. So with these accounts, you can transfer the money that you want to fund your investments with into and out of your account, similar to a bank account. But the difference is we can use this money to purchase things that will further grow our money, rather than just letting it sit in your account. Now, there is a common misconception that you have to be 18 or over to start investing, but this is not the case. So, for example, let's say I am a 14-year-old, and of course, I'm a perfect proof of a young investor. So this could be made possible because I opened a custodial brokerage account with the help of my parents. So this is the key to investing early. Next slide, please. So now that I have you hooked, let's talk about the two different types of brokerage accounts. So the first one is called a full service brokerage account. So the main benefit of a full service brokerage account is that there's a person or a team managing your investments and a lot of times advising you on what you should further purchase. Although these accounts come with a professional advice, the downside is that these are a lot more expensive as it is someone's job to manage your investment. So you have to compensate them accordingly. So this is why full service accounts are generally recommended for adults or investors with larger incomes that have number one, more assets to manage and higher incomes to pay for this type of account. Moving on to discount brokers. So discount brokers are basically the opposite of full service brokerage accounts because these take a do-it-yourself approach, DIY approach, and don't have any advisors managing your assets because there's no one managing your portfolio and you're making all your investment decisions and doing the work yourself. Discount brokers are a lot less expensive and you have to pay a lot less to purchase your securities. So this is why we recommend discount brokers to teens and anyone who has relatively simple investment portfolios and who don't have the money to spend on a professional advisor. So discount broker services, we really recommend TD Ameritrade, E-Trade, Charles Schwab. I'm so sorry if I pronounced that incorrectly. Vanguard and Fidelity. So some members of our team personally use TD Ameritrade and they love it because they are willing to put in their research and that they don't have to pay for someone to manage their investments. Next slide, please. So these are the steps to create a brokerage account. So first one would be decide on the account type. Step 2 would be to pick a brokerage firm or service. Step 3 is to enlist the help of a parent and open the account. And lastly, is to begin your investing journey. So step 1 is basically deciding on an account type. And basically here, you have to ask yourself, will a full service or online broker better meet my needs and priorities? So once you've figured out which type of broker you want to pursue, you have to pick a brokerage firm or service, and you can start by looking at the brokers we recommended, but it is also important to do your own research. Some key factors to look for are to look for providers with no fees or minimums. Number two is to consider commission fees on investment. And number three is to make sure that the service is easy to use and you will understand how to purchase your investments. And lastly is to look at the selection of securities that the firm offers and make sure that they have everything that you would want to invest in. So step three is enlisting the help of a parent, because as we know, you can't open an account by yourself. When completing this process is usually relatively simple and completed fully online, so it is accessible to anyone, anywhere, if you have stable internet. So this process usually takes 15 minutes or less, so it really shouldn't require too much effort. And lastly, you just need to start researching and start investing. And if you've gotten here, then you are really set. Next slide, please. So moving on, as some of you may know, it is important to invest to grow your money and beat inflation, but it's also really important to have a stable source of cash that is risk-free and liquid, and that you will always have in your back pocket. So saving is also really important. So here we are going to go through steps and the factors to look for with savings accounts. Next slide, please. So what is a savings account? So a savings account is essentially an account that allows you to deposit a certain amount of money and earn interest for the amount saved. So the interest paid on a savings account is quite low, and thus it is a good idea to invest your money in order to have it truly grow. With that said, savings accounts are still useful for saving your money. Next slide, please. So now that we've learned about savings account, so let's learn how to open one. So the process is relatively simple, and the first step is choosing the best bank account. So first off, you need to consider opening an online high-yield savings account, as normally savings accounts give around like 0.01 or 0.1% interest rate. But obviously, we want something a little bit higher than that. So some online savings accounts can even get to 0.5% or 1%. And this is why it's really important to research and make sure that you're getting the best. So then secondly, you need to look for an account with no opening deposit and low maintenance fee, because these are important factors in choosing a bank account. Next, you're going to need to enlist your parent once again and set up your account. So this can be done either by heading to your local bank if you're choosing to go with a brick and mortar bank and submitting your application along with your initial deposit. So if you're deciding to go with an online account, you can get a parent and sit down and submit an online application, which is similar to brokerage account and should again take 15 minutes or less. So as I said, this process is really simple and easy, and in no time you'll have an up and running bank account. So now all you need to do is to make periodic deposits to make sure that you're saving as much as possible. Next slide, please. So in conclusion, setting up accounts for your money does take some research, but all in all, the process is super easy and anyone at any age can start their saving and investing journey. Okay, next slide, please. Okay, but before I test your knowledge, I have a question, and someone has a question in the chat box. Do you pay the brokerage firm for being the middleman? Yes, I think there is a fee, like a minimal fee for the that goes to the brokerage firm. Yeah. Okay. So my first question for you guys is, what is the main difference between a full service and an online brokerage account? So feel free to type it in the chat box or feel free to unmute. Okay, Kasham says the price. Yes, The price is one of the main differences between a full service and an online brokerage account. And who is actively dealing with your investments? Yes, that's right. Okay, the second question is, how can someone open a brokerage account if they are under 18? Okay, that's right. So, if you're under 18, you can open a custodial brokerage account with the help of your parents. And this is obviously the key to investing early. Okay, next. Why do we recommend online savings accounts? Okay, you can type your answers in the chat box or feel free to unmute. Okay, yes. One of the reasons why we recommend online savings account is because some offers like very low maintenance fees. Okay, yeah. So yeah, that's actually it for my presentation. So I hope you've learned a lot, and yeah, I hope you guys have a great day. Thank you.
Okay, great. Thank you so much, Gianna. I hope everyone learned a lot about the topics that we presented. And now I'm going to play some music and we can take a break before we're joined by our first guest speaker for the day. Okay, so now our break is over and we're joined by our first guest speaker for the day, who is Harrison from Bumper Investing, and he's going to be talking about financial literacy with us. So feel free to get started whenever you're ready.
Awesome, thank you so much. Yeah, let me share my screen here. Sweet. So, yeah, really excited to be here. Appreciate you guys inviting me to kind of talk about kind of fintech and its kind of industry nowadays, and the ever-evolving space of both fintech and technology and finance. With that said, I'm Harrison Martindale, as Armenia mentioned, and I'm the education lead for Bumper Investing. And I think you guys have Luke, who's our CEO, kind of come through here, I think, in the past, to talk a little bit more about other topics. But yeah, I focus more on the educational stuff, so the educational content that you'll see on the platform, we'll just kind of get into. But today, we're covering the several components of fintech and how it has become the ever-evolving industry of both tech and finance. So I'll also be using Mentimeter in the time being. So I'll send a link here soon because we're just going to have a few interactive questions that kind of pop up. But first off, I just want to say Bumper is a fintech. So that's kind of what we'll be talking about solely today. So if you ever need an example of what a fintech is, you can think of us. Essentially, what we're trying to do is use technology to solve a problem that teens endure when they're trying to jump into the finance realm. So what is Bumper? So we are a VC-backed company that enables teenagers to begin investing early on. Currently, there's no platform that really provides a network of teenagers an investing platform. So there's Robinhood, which is all 18 plus, but there's nothing that allows teenagers to be investing early on. And we kind of wanted to bridge that gap and provide it both accessible and then also provide educational content for those teenagers to really learn about what they're doing on a platform. And we've been very fortunate so far to raise over $600,000. First $100,000 actually came from an accelerator round, and we can talk more about that if you guys are interested. And then recently, we were able to raise $500,000 in pre-seed round from angels and other investors in Nebraska, which is where we're based out of today. So, all right, and then we really are just a young team trying to have effect on this investing space. It's very complicated, a lot of regulation, but we really have a positive impact on both investing for teenagers, providing them an opportunity. Secondly, also providing them an ability to gain real concrete understanding of what they're doing in the investing realm and help educate them to become better financially independent going forward in the future. So enough with the kind of the overview of Bumper. We'll kind of get into some of the bulk of what we're talking about today, which is going to be fintech. And kind of the first component of this fintech piece is going to be startups. And it's kind of what most fintechs are. So yes, as I mentioned, most fintechs are startups because there's probably thousands and thousands of companies out there. But since you're dealing with technology in this finance piece, a lot of them are trying to prove themselves early on. So they're still working on the technology. They don't have revenues quite yet. And they also produce a very scalable product, which we'll kind of get into here. So they're using technology to solve a finance related problem. So Robinhood is a great example of this. To provide an online brokerage firm that allows you to begin investing right away. And then also, there's no commissions attached to it, which is really revolutionary in the time when it came out. And what a startup really is, it's an innovative product and a scalable business model. So an innovative product is what Robinhood did. It seems commonplace now, but back in, I think, 2013, when they first released their platform, it was very innovative in terms of a different way to see how you're investing. And then also they built a scalable product to allow people to have millions of investors, have $1 million of revenue, which kind of differentiates it between a startup and a small business. So not every company is going to be a startup because they do have to have those components of both being innovative and then also scalable. Which kind of differentiates yourself from being Robinhood or a local diner, because a local diner can only cater to its sole geographic region, while Robinhood can reach out to millions of other consumers in the U.S. So just as a question here, we'll kind of get into, but to log on, you can either go to menti.com and then use this code above, but also share a link in the chat so you can all join. But just want to get your thoughts on what you think might be the correct answer. What percentage of fintechs fail? It's actually kind of pretty interesting to see because they are trying to prove a company that's been really early on. So drop your thoughts and then we'll get into it. 90%, 60%. You guys are pretty pretty optimistic about these. I mean, pessimistic about these companies. All right. We've got a few more seconds and we'll jump into the correct answer here. All right, so the right answer is going to be 90%. Oops. There we go, should show the correct answer. But yes, so 90% of startups actually fail, especially fintech related, because you're attempting to do something that's never really done before. Especially with this fintech space, they're messing with new technology that really hasn't been proven, and it's just completely new to consumers. So pushing that into the market is very skeptical. They don't know how people will react, and it's really interesting on how they're able to scale and find out essentially what they call a product market fit, which means that consumers enjoy your product and are willing to take it and run with it to build that scalable side of the business. And Elon Musk kind of has a famous quote behind this, and essentially saying that running a startup is like chewing glass and staring into the abyss. It's a very negative way of kind of phrasing things, but essentially the idea of saying something like this is that you're constantly running into obstacles with the idea of chewing glass. And staring into this essentially meaning you're attempting to do something that has never really done before. So for like when he was starting Tesla, there's really no other big EV companies, so there was no roadmap on how to properly go about building a electric vehicle company. Now the roadmap has kind of been laid out by Tesla and these other companies, but early on you have no idea how you're going to run that. It's kind of another reason why so many companies fail. That kind of goes to iterate how difficult it is to really start a fintech company and scale it and build that innovative product. But now we'll kind of get into some of the position in the market and kind of where fintech kind of lays in this crazy evolving market. We'll kind of dive into some quantitative stuff, but first off, we'll kind of recap on what fintech's goal is. Its main goal is to solve finance-related problems. Essentially, what they're trying to do is capitalize on all the digitalization that's occurring from an old industry with their new technology. Because so many banks use pen and paper back in the days, but then other companies have come in with technology that provided them an innovative way to do it much more efficiently. It has increased productivity. It has kind of revolutionized the way we do other financial related things. So banking would not be where it is today without fintech. There would be no apps that you can access on your phone and have instant access to your balances and stuff like that. And then additionally, there is a huge market for both the B2C and B2B markets. So B2C refers to business to consumer, and then B2B refers to business. I'm sure you've kind of heard of some companies that are B2C. Robinhood is example one, Bumper is another. However, B2B actually makes up most of this market because there's so many innovative solutions that these companies actually desire and need in order to kind of fulfill some of their obligations to their consumers. So it's actually a major part of this, and you don't hear a lot about them, but you actually used a lot of them. And we'll kind of jump into some examples of what those look like. But really, fintech just helps evolve these companies, these old companies, and innovate them to become more digitized and more in the modern era today. So how big is a market like fintech? So it's actually huge. It's estimated to be 324 billion just in 2020. And this is also assuming a huge growth rate going in the future. So it's awesome to see fintech growing, especially us becoming more tech savvy. So everything's evolving quickly with us. So we also have to kind of endure the pain of new technology constantly as it becomes more prominent. And it has become one of the top growing industries, making it really good if you ever consider going into a career opportunity in fintech, because there's so many opportunities available because so many companies are going into this space today. All right, now the question for you is, can you name a large fintech company? So I mentioned some here already in the past. Don't use Bumper, you already know that one, that was handed to you. But there's tons of other ones that you probably experience, even when you're going to like checkout of stores. Like I was on American Eagle the other day and I realized there's this huge fintech firm that just sits in the checkout box that uses technology in these transactions, but you don't realize it because they're more the B2B, the back end side of things. So there's so many companies. I was curious if you guys had any ideas on some of these other large fintech companies. Yep, Robinhood. And then to access that, guys, you can just go to that link I listed in the chat below, or you can go to menti.com and enter in that code. We'll give a few more seconds and then we can kind of jump into the rest of the position. Chime, yes, Chime's become a really big one, especially recently. Stripe, yes. It's crazy to also see like Stripe. There's tons of others like Plaid. I'm spacing on this other one that's pretty big, but these credit card processing companies have become huge fintech companies over the past like 5 years even. So their scalability is massive and interesting to see going forward. PayPal, Coinbase, yes, all really good examples. So we all know these companies, we've heard of them. So Stripe was mentioned, Robinhood was mentioned. And if you don't recognize any of these companies here, they are probably going to be those back end things like the business to business that do credit card payments, credit card processing. All these help to make the experience of going online, experiencing finance in a very easy, seamless way. So we appreciate most of these companies that has helped us, especially begin investing early with like Robinhood, but then also made some transactions really easy, like Stripe and Plaid, with integrating different items to bank accounts and making integration really easy and simplified. So where does the position kind of lay for some of these legacy financial institutions? And what I refer to as like a legacy financial institution are these older companies like banks, financial services like JP Morgan. There's tons of different institutions that have some finance related thing going on with them, but they've really started to feel the pressure of fintechs over the past few years. And Goldman Sachs has kind of estimated that fintech has been able to steal or kind of capture from some of the existing financial services company 4.7 trillion annual revenue, 470 billion in profit, and then also fractional points of market share. And these fractional points of market share can mean even more than the revenue or points because they're disrupting the company's total value going forward, and they're affecting the long-term value of these companies' performance. And these fintechs are just taking away this market share from all these existing financial services firms, which kind of put them at a detriment, especially forward-looking, because eventually the fintech will eventually take over their market share entirely. So they have to find quickly ways to innovate through that. And they kind of left us with 3 options. So institutions face 3 things, and that is either the wait and see approach, acquire fintechs, and partner with fintechs. So first off, we have the wait and see approach. It's as simple as it sounds. It's just sitting back and watching what other firms are doing along the way, whether they're acquiring fintechs, partnering, or converting to a fintech. This is really the safe approach, but kind of puts you at a detriment in terms of you're always going to be the last to market. You might lose a ton more market share than these other companies, and it runs a big risk with just waiting and seeing how things operate. But it can be good if fintech maybe goes under, no one wants to adopt to it. But then secondly, we have acquire fintech. So this is definitely the more aggressive style that many businesses are taking, essentially capturing a new market share by purchasing a business or a fintech. So if another company like a bank wanted to purchase Bumper, they'd buy us and essentially provide this product that we have to their consumers to capture that new market share of teen investors. But this is really capital intensive because it does cost millions of dollars to purchase a company. And I'm sure you probably heard some headlines of some astronomical billion-dollar exits of fintech companies to these other big institutions. And why they do this is because they want to be able to innovate in their space and not just be left behind with just their deposits or their savings accounts. They want to find new ways to reach their customer demographic and help their consumers. And then lastly, and probably the most common is what you find is that a lot of partnerships with fintechs. So they're not buying them, they're just entering in a mutualistic way to benefit each other, whether that's going to be capital, whether that might be an example of this would be kind of like banks providing a fintech capital or backing behind them, essentially just so they can capture more market share. So since these fintechs are innovating so quickly, they do need some banks or some other institutions to kind of back them. And having this allows them, like the bank, also to gain revenue and other alternative ways to kind of capture some of those revenues that were lost to these fintechs. It's been interesting to see which approach they have taken, and it'll be interesting to see how, as this continues to evolve, if fintech will eventually take over, or these banks will innovate enough to stay ahead of this ever-evolving space here. All right, so now we're going to jump into some of the effects of personal finance. And I'm sure you can all have felt some of these, and we'll talk about each of them in depth here. So there's been tons of different ways that fintech has affected personal finance, where you mentioned Robinhood, Bumper, there's a trillion other ones, but we'll be covering three main ones. First going to be the digitalization of investing and budgeting. Secondly is cryptocurrency and blockchain, honestly like a buzzword nowadays. And then lastly, we'll be talking about robo-advisors and kind of their role and how they will innovate, or how they will grow in this fintech space. So first, I'm talk about the advantages and disadvantages of digitalization. So all transfer information can now be done online. Awesome, this is perfect. Now that we can send our friend text, now we can buy something online right away. We can transfer money to someone else, a friend, through Venmo right away, which has been really convenient, but it's come to a detriment of other things like security, which has proven a much bigger problem, and another reason other startup companies are able to rise, just because they're solving different problems that these fintechs are now uncovering. And secondly, with this ability to make everything done online, it has advanced productivity and the speed of the market for everyone. So now everyone doesn't feel like they're behind. Everyone has instant access to nearly everything with just the touch of their phone, which has been really convenient. But again, comes with security violations and concerns. And lastly, it really has broadened the scope of investors. And what I mean by this is that it has opened many people to investing that never really thought they'd begin. So Robinhood is a perfect example. Again, they provided 18-plus-year-olds a new platform to begin investing that was attractive, that was gamified. And a ton of new investors poured into Robinhood because it was this new way to be investing, easy, simplified. But this also, again, comes at a disadvantage because it has honestly kind of fostered poor investing habits for these newer investors that are kind of unaware of everything going on, which is why it's always really important to have education behind yourself and have a good financial education of how to interact with some of the financial markets. So these disadvantages, I already touched on a lot of these, but has opened investors to cybercrime. So I'm sure you all heard of those Bitcoin stories where some guy lost $1 million of Bitcoin or something like that, just because someone was able to hack into his account or find a way to steal that money. This is now a concern. In the past, this never was, because everything was either dealt in cash or a much simpler way, or is held through a bank. And so, secondly, we have the lack of trust and transparency. This is just because you're entering like sensitive information into these into the internet. We don't know where it's always going, so there's always a big concern for us, and how are we going to deal with that? And lastly, again, pointing out that all these new retail investors entering this investing space is really good, but has also fostered really poor investing habits, which has honestly led to a lot of unfortunate stories. So there was a student actually in UNO who actually ended up committing suicide after trading on Robinhood after a trade goes bad. So like these aren't always good, positive things, but there has been some benefits. But again, these always come with negatives associated with them. So now to the two buzzwords that we have, which is going to be cryptocurrency and blockchain. I'm sure you've all heard of both of these and kind of what they mean in terms of fintech and the space of investing. But cryptocurrency is essentially just a disruptive, decentralized virtual currency that is distributed across a network of computers. So your Bitcoin, your Ethereum, there's tons of thousands of other coins that are being offered. It's kind of a scary realm, honestly, here today. Essentially, just provide a faster and cheaper way to transfer money with anonymity, which is kind of at some advantages. It's proposed some concerns for the government and how they will tax it. But overall, it does come at that cost. So it is highly volatile, meaning that it fluctuates in value rapidly. So Bitcoin can go up 5%, but then also go down 20% in less than 10 minutes. That is not as common with stocks. It is possible, but not common at all. Well, this is like very, very common with cryptocurrencies. So this again goes to the advantage of being financially literate and understanding the risks that come with these securities that you are trading. Secondly, it is used criminally. So with an anonymity piece, these criminals can, fund each other all without being known or what they're actually doing. So that is a big cost to the environment, and why there's been some other companies, other fintechs that are trying to solve that in a different way. And then also it comes at the disadvantage of coming at a very high energy cost or high consumption cost, because mining Bitcoin does require you to have computers that consume all this energy to produce these Bitcoin and cryptocurrencies, which have an effect on the environment. All right. So now on to blockchain. So essentially what this does is just store information electronically in digital format. This is extremely crucial to cryptocurrency because it is where it's housed, it's where it's traded on. It's kind of like the record of exchanges between consumers. So essentially what it does, it just removes the third party and ensures that the security of a transaction. So in today's environment without cryptocurrency, we have a buyer and we have a seller. And in the middle, we have the third party, which is going to be your bank or financial institution. Essentially, we're taking out that bank with blockchain because all you need now and with cryptocurrency is a buyer and seller to bridge the gap between those two, which honestly also minimizes fees and other costs associated with having that third party. But why is it called blockchain? So it's called blockchain because it stores data in blocks, and with so many blocks of data, it creates a chain, which is kind of what the visualization is on the bottom left there. But we can't really talk about cryptocurrency and blockchain without bringing up the crazy stuff that's going on with NFTs. I'm not sure if you guys ever heard about them, but NFTs are just what they call non-fungible tokens, and they represent a digital asset that is a unit of data on a blockchain. So very kind of theoretical sense, kind of confusing, but it really goes hand in hand with crypto and blockchain. Blockchain because it's essentially a data point or a block on the blockchain, and then essentially how you buy and sell these NFTs are going to be through crypto. So you have Ethereum, you have Bitcoin, and you buy and sell these icons that are kind of just like listed down here below. These are NFTs, and people are buying these for millions and millions of dollars. They have astronomical prices that people are actually purchasing, which has been a really interesting case study to kind of understand why people are actually buying some of these crazy expensive just pictures because they're unique, they're one of a kind. But it'll be interesting how this NFT market plays out going forward. All right, so now robo-advisors. So essentially what a robo-advisor is they're just a digital financial advisor that provides advice based on algorithms and mathematical models. And they've been really great because they lowered the barrier of the cost for investors to receive financial education and also advice on how to trade. But they also come with a disadvantage of having a lack of human interaction. You've heard me talk about this a lot, how there's always a disadvantage to this new technological advancement. And with robo-advisors, this is going to be, you're not talking with financial advisors. There's not going to be trust built with you. You're talking with a computer, or you're just, they're just sending you information of like, hey, buy this stock, hey, check out this. Because they're just algorithms that just run and give you probabilities of success. And with that said, I do have like 2 questions for you guys. So do you enjoy less interaction when discussing finance? Is that something that you would enjoy? Would you consider robo-advisors? And then secondly, would you take advice from a robot that manages your finances? Because personally, my parents could never probably take advice from a robot because they probably think that they're smarter than a robot or just kind of skeptical of that. So they would enjoy more financial advisors. Well, I'd be more comfortable with trading with a robot or just AI piece that tells me good things to invest in. But I'll kind of open that up here and let you guys do some of the scales. You can strongly agree to each of these statements here. But really interested to see what people think about it because I want interaction when I talk with finances because, it's a sensitive topic. But then also, it's also good to feel like you don't always have to talk to someone. You can talk to an AI that can help you much more, it feels like. So I just want to get your thoughts there for everyone, how to feel about that. So it looks like everyone wants to kind of take advice from robot, and then also less interaction. I like it. I heard it's legal to copy and paste NFTs. Is that true? So NFTs are really unique. So they are just a picture. Like you go on your phone, you open up your photos. Those can all be created into NFTs. Essentially what an NFT is just a digital collectible, or that digital asset that I mentioned, that is placed on a single point of the blockchain. And that's what makes it unique. Since it's on that single point of the blockchain, it makes it unique from anything else, and makes it distinguishable between something on your phone to something actually on, something on your phone for something on the blockchain. And that's what differentiates. So copying and pasting an NFT has no value. Like you can take a picture on any NFT brokerage site, like there's one called OpenSea. There's tons of different NFTs on there, but if you take a screenshot, that means nothing because you don't own that specific point on the blockchain. Let me know if that makes sense. I know it's really, really confusing on how like these NFTs work, but it's really interesting to see how people are trading for them for like millions of dollars. So, all right. It makes sense. Yeah, I know it's confusing. I think there's, and we'll kind of get into like some education pieces on like some educational sites available. But if you ever have questions about some like financial related topics, I always go to Investopedia, and I'm pretty sure they have some good content over NFTs if you want to learn more about it. All right. So now kind of recap some of the effects of personal finance. So personal finance is becoming much more DIY, meaning it's all do-it-yourself stuff. And it's honestly come at a lower cost, but with more risks and mistakes associated with it. So you can now trade on your own with no commissions, which is all great, but does come with the disadvantages of you're managing your own money now. So now there's much more emotion tied to those investments instead of just having a financial advisor, because with a financial advisor, you trust them. You think that they will make a good investment decision for yourselves. And then lastly, it's more important than ever to have a strong financial understanding of these different topics and in finance, because there's so many that keep evolving. Like NFTs is a great example. So this came on the scene about a year ago. Well, they came on the scene about like 10 years ago, but they didn't really become popular about a year ago. And having understanding of like how blockchain and cryptocurrency works, and having those fundamentals down before you kind of dive into the deeps of what these NFTs are is really, really important. How would we start with NFTs? Great question. So it's honestly a difficult realm and requires like what they call minting. Minting is when you buy a initial, websites and photos. So great websites would probably be OpenSea. That's a brokerage website that they have where you buy and sell NFTs. But I do warn you, like there is some crazy volatility with NFT prices. Why is there conversion on why NFTs are problematic? So NFTs are just, I don't think they're problematic. I just think that it's crazy to see all this controversy in terms of the prices and the supply and demand aspect of it. There's no like dramatic conversations on them being regulatory or politically charged or anything bad happening, but just the controversy in terms of the crazy price dynamics that have been endured over the past year, because they really haven't come to market for that long. All right, so now the kind of last part of today, we'll just kind of be covering investing in today's era and how to really do this, all this stuff going on with Robinhood, Bumper, and all these other tons of different investing platforms. So it's easy to kind of distinguish. There's about 4 big things that have kind of involved in today's investing realm. First being financial shares, fractional shares, sorry. What these do, provide you fractional bits of ownership in a company, which has lowered the barrier for you to actually begin investing right away. So you can invest just $1 into Amazon when it's actually $3,000 stock. Makes it really easy for people to start right away. Secondly, there's been a ton of misinformation about this investing space. I mean, the first perfect example of this is going to be Wall Street bets. I'm sure you've all heard of it. When the GME AMC crisis was hitting, tons of people were spreading information about not Robinhood, but GME, AMC, and how where it was going to be priced at and how they were going to work that out. And then third, we have gamification. This has really been done well by Robinhood, but also at a detriment. Again, so this gamification brought new investors in, made them more attractive to wanting to invest. But secondly, it's also made it a game for people, which is both good and bad because they're playing with real money at stake. So there's real risks associated with that. And understanding like the true consequences of gamification is also important to consider, whether it's always good or whether it's always bad. And lastly, there's been a real desire for short-term gains over the past about year and a half. Ever since COVID really hit, since there were so many new investors that jumped on, they wanted to make quick money right away. So they aim for these short-term gains because now you could have fractional shares, you have crypto, you have these highly volatile things, and this ability for many people to jump in the market right away has caused for people just desire to jump in a position really quick and then jump out. All right, and then I'll just finish up this question. So in your opinion, is crypto trustworthy? Yes and no. I think it entirely depends on where you're trading the cryptocurrency. So there's many platforms that honestly are like borderline illegal, and being conscious of what ones those are, but then also be conscious of the good ones that you're investing on. So there's a ton of them nowadays. I would recommend like Coinbase. Coinbase is a very reputable company, has been doing it probably the longest for trading cryptocurrencies. But there's so much more to cryptocurrencies that go beyond just buying and selling it, because there's also something called cold and warm storage, which is a way of securing your Bitcoin or cryptocurrency investments. We won't dive in that today, but there's a ton of different things that kind of play a role into cryptocurrency's trustworthiness that you kind of have to investigate on your own and determine if that's going to be a suitable fit for you. Another question is, can you tell us how was your experience when you started NFTs, and did you ever buy or sell them? So I don't have a ton of experience with trading NFTs, but I've talked to a lot of people about them, and I actually have a few friends that trade NFTs. I think it's a very interesting space. It's very, very hit or miss. Like if you guys are considering going into it, honestly, there's tons of other ways to make money in like the normal investing space. Just because people are making millions doesn't mean you will, because how NFTs works is that you just kind of have to guess that this image or this picture is going to blow up over the next few months, and determining what pictures or what images are going to blow up is nearly impossible. It's like guessing what penny stock will go to $1 million in the next week. It's so hard to guess what this is. So honestly, just stick to other ways of investing, because it's so volatile and hard to guess what's going to go to the moon or whatever they think. What are the terms they use to describe it taking off or rising in value very quickly? All right, so how do you combat some of this today's era, or how do you invest with all this stuff going on? So first of all, I think setting goals is really, really crucial. It's so cliche, but honestly, it really, really helps you understand, like, are you going to invest in NFTs? Are you going to invest in ETFs? What financial instrument would be good for you? And then also it helps you align with your financial goals going forward. We'll talk a little bit more about that soon. And secondly, understand your risk tolerance. So risk tolerance we'll get into exactly, but like NFTs, very, very high risk, while stocks are a little bit below that. Like stocks are still high risk, but still below NFTs because you kind of understand their value a little bit more. And NFTs have been more newer in this new financial instrument that people are using. So understanding what risks are associated with your investment is really important. And then third, obtain financial literacy content. I've echoed this multiple times in this presentation about how important it is to actually have a good understanding of what you're trading, what you're investing in, to associate what those costs are for going forward. And lastly, I do recommend everyone to start right away. I think the power of investing early is so crucial to your long-term financial success. And I'll kind of have a chart at the end here to kind of depict what that future might look like. So goal setting. So again, cliche, but setting goals allows you to understand why you started investing initially. Is this because you want to retire early? Is this because you want to save for college? Is this because you want to save for a car? having these clear investing goals allows you to kind of understand what you're going to invest in. So if you're trying to make money for maybe the next day or something very short term, then might be more important for you to go to more risky stocks and more volatile stocks. But if you're trying to go for long-term financial success, that might mean more broad-based index funds or more safer investments. And the second part of goals is that help keep track of where you have been, where you are, and where you are going. So it kind of lays out a roadmap of how you progress through these avenues in your life. And then lastly, it helps you build your long-term roadmap to financial success. So if you're able to spend $10,000 by 30 years old, then you're hitting your metrics to eventually reach your inevitable goal of reaching retirement, financial independence, financial freedom, whatever goal that you have in mind. Setting these goals now and starting to invest in early is so crucial because it'll help you hit all of these going forward. All right, so risk tolerance. So every investment involves risk. We've already talked about that. Everyone has a core understanding that everything does have that. And then risk tolerance is essentially how willing or comfortable you are to risk losing your money on an investment. So I would say you're kind of bound to lose money while investing, but you're also bound to also potentially make returns. So understanding like where your risk tolerance is at in terms of how willing you are to lose money on certain investments is really important. So there's 3 risk tolerances. There's aggressive, conservative, and there's moderate. Understanding which one you lie on, there's multiple tests you can figure out what you are, but they help determine what you might want to invest in or what you're comfortable investing in. Because if you invest outside your risk tolerance, maybe invest in crypto for the first time when you have more of a moderate to conservative risk tolerance, then when you see, cryptocurrency go up 10% and then drop down 30%, that's obviously like internally, it causes some emotions to kind of strike. It might cause you to sell the investment prematurely or unexpectedly because you don't want to lose that much money from investment, which might make ETFs or index funds a better option to invest in. And lastly, kind of echoing what I talked about already, is that understanding your risk tolerance allows you to make better investment decisions. Because it allows you to be more comfortable with what you're trading and what you're investing in, because that's what you know, that's what you trust going forward. Get a question in chat. At what age did you start investing? I started investing at 16. So how I did mine is I opened a custodial account. If Bumper was available, I definitely opened accounts there because it's just easy to process. Because when I started investing, it took 2 weeks to open an account, which is insane today because like on Robinhood, you can open out your account in 1 day. But if you're a minor, there's a few other things that you can do, but with Bumper, we've been able to allow the account to be able to open in like less than a day or 2, which is really convenient and allows you to get started right away. Is 13 too young to start investing? No, 13 is actually the perfect age to start investing because this is honestly like, so the 13 is only like the minimum age you have to be. So you are in a perfect position to start investing today. And you can jump Bumper or whatever other investing platform you feel comfortable with. But totally recommend doing that. Have a conversation with your parents, honestly, too, of their investing experience, and if they're not comfortable having that conversation, I definitely would love to follow up with you. We can talk to that conversation on how to really get started investing, because I know it's a really like scary and intimidating thing to really begin with, but it's definitely something that's worth exploring. So where did you first invest in? I first started through TD Ameritrade. I do like, they have a great account. It just does take a ton of time, which again, why like the great thing about Bumper, because it simplified that process and allows you to have more education as well. But you should also research the company that you're going to be investing in. Not the company you're investing in, but the company you're investing through. It's really important to understand some of the background of the company, and then also how they can do some taxes and other complicated stuff. And if we want to talk more about that after this presentation, we definitely can. Can you share your socials for further purposes? Yes, of course. I'll dive into that at the very end, because in the very end we'll do a little bit of Q&A at the very end of this here. So let me wrap the rest of this up. So education. So find sources that produce reputable and reputable financial content. So I already mentioned Investopedia. Investopedia is probably one of the greatest, I mean, after Bumper Bites, which we'll get into, but Investopedia has a library of thousands and thousands of different financial concepts that dive deep into the meaning and the understanding of each topic, which is where I always go after Bumper Bites, of course. So Bumper Bites are actually the new thing that we've released, which are just bite-sized educational content in sort of a short form. So it's about a 40-second read for each little bite there. But it's really good because it's just digestible and really easy to understand right away. So we have so far we just have very basic things like investing 101, how to start investing, stock market, stock exchange, stuff like that. And by having a good understanding of finance allows you to understand current and future market conditions, which help you investing in the stock market. And then where do you learn about investing in finance? So what platforms do you currently use that have been really beneficial for you going forward or already? Also, I'll drop bumper bites in chat. May I ask how old you are now? You're so knowledgeable and you look so young. I appreciate it. I'm actually 20 years old. I'm currently attending college in Nebraska here. But really, finance has been like a really core part of my life, which is kind of why I know a little bit about it. And it's also really easy to stay on top of things, especially when you enter the space, because there's so many different things coming at you all the time. But it's also so interesting, and if you have a knack for it and like learning more about it, it's such an interesting thing to get into. All right, and so yeah, the question, also drop the link in chat because I know there's some new attendees. But if you just go to this link here, you can sign in to kind of answer these questions. So where do you learn about investing in finance? So what realms, but what websites do you utilize to understand more? And if that's none, that's fine. You can just drop in none, because I know a lot of people don't always know where to go for this financial education content. None, yeah. All right, we'll get a few more seconds, and then we'll kind of do Elon Musk Twitter. I know he's a character, that is for sure. Don't always trust what he says though. None as of yet. Yeah, it's totally understandable. Like, I honestly would just go to teachers at my high school and ask them questions about it. It was not always the most effective way, but I was lucky to have some really good business teachers, which kind of influenced me to go into this finance space. But also, I think having a conversation with parents is always really, really important. If your parents don't, again, have like that core understanding of finance, again, love to sit down with you, and I'll drop my my links and socials down below. Some people use TikTok. Yes, I know TikTok has become like a really big one now. It's become sometimes concerning because I hate like people that just do like get rich quick stuff, because that's not practical. That's not real life. People saying you can, open up a company and make millions of dollars. Like, that's not true. When the random urge hits to research more about financial stuff, I totally feel you. I've done that a ton. Personal finance teacher, awesome. Okay, random research on the internet mostly. I know. So honestly, a lot of my financial education that also come from like sporadic moments. You just hear about NFTs or this new market popping up, and then you just kind of dive deep into this rabbit hole of different financial concepts. Clickbait, yeah, that's the perfect way to kind of describe this TikTok market of finance. All right, and then we'll kind of wrap it up here. Oops, haven't been updated since the GameStop event stuff. Yeah, the market has been kind of interesting. Like, I would actually recommend you look back into some of the stuff, not always the Reddit stuff, but some of like where the market is today. If you guys are looking for good reputable sports sources, Wall Street Journal has really good stuff. It's like $4 a month. Yeah, $4 a month for students. So it's a great opportunity to learn a lot about this huge finance space. Secondly, Morning Brew is also a really good source to get some good financial educational content in terms of like today's market conditions, stuff like that. All right, so lastly, starting early. So by starting early, you get more time, which is why it makes it so impactful. Secondly, that'll lead to more compounding, and compounding is just making money on top of your money. And with more compounding comes more money over the long term. So with this huge time span, this ability to make more money, to invest more money, you're just accumulating more going forward. And secondly, you can take more risks. So you are at a young age where you can invest in more risky things. Don't always recommend it. Again, entirely depends on your risk tolerance, but understanding that you're able to make this more risky plays because you do have the time and duration to make that money back going forward. Secondly, thirdly, you can be ahead of the curve of everyone else. It was kind of jumping in the investing space. So like I was so grateful to kind of have a good understanding of finance really early on, because I know like many parents or even your peers don't always have a good understanding of finance. And you guys being here today is really impactful, important to your education, and they provide a lot of value to you, not just me, but there's tons of others I'm sure that come through here and talk about great things. And they put you ahead of the curve and have a good understanding that will help you become financially independent adults going forward. And lastly, improves your financial habits early on. So these are really good because you're actually gaining real investing experience. You're experiencing these emotions at play that happen in finance, and you'll be able to kind of adapt going forward and have a very strong emotional intelligence, but then secondly, also financial intelligence on how to properly trade. And this really depicts the power of investing. So by starting early with just $100 investment until you eventually retire, this $100 can turn into $12,000, just leaving it there based on like S&P 500 averages of the past 50 years, which is awesome to see in comparison to something like savings. So savings only takes, it produces a very small return and is almost approaching zero currently in today's environment just because of inflation, because of a ton of other things. But with investing, you just have this power to compound your money over time. All right, and then my last question for you guys is, do you currently invest? Another question in chat, I'm 13, investing, but I have no clue what to invest in. Most probably stocks though. Any stocks you would suggest I invest in? So determining what to invest in is the hardest thing to do in investing. I can tell you that now. I've lost tons of money. I've also made a little bit of money in the stock market, but like determining what you're going to invest in is so crucial. I honestly recommend I don't recommend individual stocks because first of all, I'm not a financial advisor, so I can't provide that advice. But I do recommend people look into index funds and ETFs. We can dive into those a little bit, but what essentially they are is that they provide a more fuller scope, or they provide a basket of different stocks. So you're essentially investing into one fund that has the ability to be diversified and also a ton of different stocks. It's essentially more risk-free. It's not entirely risk-free, but there's still risks associated with it. And I actually will drop these educational modules that Bumper has. So here's one about ETFs. If you want to look into those are exchange traded funds. They're similar to a basket of stocks. And these baskets of stocks, I should also mention, are associated with a certain industry. And then index funds are another ones that we have here. Then we have index funds, which are capture or track a certain index. So there's the S&P 500, there's the Dow Jones. You probably have heard of these, but they're essentially a ton of different stocks that make up this index or performance indicator for people to try to beat or hit. But what's the thing about index funds, you can invest in something like the S&P 500, like you can invest in that index, which comprises 500 very large cap stocks. So those are always available, and that's kind of what I suggest if you want to get into the investing space. But I'll kind of dive into another way to kind of learn more about stock analysis here soon. Can you repeat what you don't recommend? I kind of spaced on what I don't recommend, but I think just don't try to go for something that's really mainstream or has a lot of popularity currently. So like cryptocurrency, I don't think cryptocurrency is a really good thing to get into right away. I think it's a good thing to get into after you kind of have a good understanding of finance and understand stocks and all these other core concepts, because you don't know where your risk level really lies. So understanding fundamentally where you are to begin with is really important, and you'll gain that experience through investing with stocks or something with that's less volatile or less risky. Was it unofficial funds or something? It was index funds. So index funds, I just dropped a link just above your comment there. But yes, index funds are a great way. And I call them a copycat because they mimic different stock indicators. So sorry, going back to the presentation, do you invest? So it looks like a lot of people don't, but they want to. That's awesome. We'll kind of get into kind of what the Bumper app provides if you guys ever want to consider that. If you guys are above the age of 18, there's tons of different platforms available to you. But yeah, let's get into it. So what is the Bumper app? So we provide an investing experience for teenagers. I've touched on some before. Currently, there's not a ton of opportunities for these teens to kind of jump on the space. But with this Bumper app, where you're able to invest with just $1, but you will need an adult sponsor on your account because you are under the age of 18. And then third, learn about the stock market through bite-sized modules. So this is the great thing, I think, about Bumper, because a lot of platforms neglect the ability to provide educational content while they're actually trading. Because when you actually go to trade your first trade, you don't always know what you're doing. So having this ability to kind of learn about the stock market as in tandem with trading is really impactful. And secondly, it's also coming to mobile very soon. We're just actually like a month away, a few weeks away, I think now. We currently are all web-based, but we'll be wrapping up into a mobile app very soon here. And yes, I'll wrap it up here right now. So I do want to tell you one last thing about Bumper. So we actually are currently hosting an ambassador program. It's essentially just a 9-week program designed to teach high schoolers, college students, anyone really about investing, personal finance, and startups. And ambassadors will be given a personalized letter of recommendation, earn money to begin investing, and then also gain real world experience at a high growth startup. We're actually covering stock analysis tonight and how to analyze what stock to buy. And then a ton of other things that have been really impactful and useful for these ambassadors kind of understand how to get into the investing realm, but then also how to develop their self professionally. And then with that, I'll just leave it open to questions, and feel free to check the Bumper app, and then also drop in the ambassador link in chat. But appreciate you taking the time today to see everything. Is the ambassador program in middle schools? Yes. It's really open to anyone that's willing to be actively engaged and learn more about finance. That's all we really ask people. We've had a ton of different individuals. We have about 20 currently in the program now. We're accepting willing admissions. Love to have you. We're excited to kind of help everyone learn more about finance. All right, I think there's one question above. If you're 18 plus, do we need an adult sponsor? No, you don't really need an adult sponsor if you're above the age of 18, because you reach the age of majority. But you still, currently, you still need to connect sponsor to your account, which you can use as yourself. So if you have any troubles with that, please reach out to me. I will drop my contact information down below. Feel free to email me, whatever that might be. What else? You can also feel free to contact me. Perfect. What do we need to be as an ambassador? So really all we do as ambassadors is that we just have a weekly meeting every Thursday at 7 p.m. CST. We just come there and we talk about a financial concept. We also do feedback stuff, so you guys actually have an impact on how we develop the Bumper platform. So I think last week we covered some mock-ups that we have of some of the app that we're trying to develop, and then you guys get to provide real world. You could apply what you think what should be implemented in the Bumper app, which has been really impactful. And then also on the side of each week we have them complete async tasks, which you are able to learn more about. You're just able to learn more about different finance topics, also develop yourself professionally. There's no really official requirements of you. On the ambassador phone, I'm in 8th grade, but there is only 9th grade and above. I just put 9th grade for the time being. That's just because how we made the form initially, but it's totally fine if you're in 8th grade. We'd love to have you join. So. CST timing, so yes, that would be 8 p.m. Eastern time, and then it would be 5 p.m. PST. I can drop that as well. Yeah.
Okay, thank you so much for the presentation and for talking about fintech as well as Bumper. I will share all of your contact information in a follow-up email. So yeah, thank you so much.
Yeah, thank you guys so much for having me. Appreciate it. See you guys.
Bye. And now we are going to be moving into our second guest speaker for the day, who is Dr. Antony Davies, and he is a professor of economics at Duquesne University. And so you can get started with your presentation whenever you're ready.
Thank you, Armita. Can you, I'm logged in twice. Can you give me the ability to share on my second login?
Yeah, I can do that.
Oh, looks like I already have it. Okay,
Okay.
thanks. Okay, so we're going to be talking about investing. And just to start off at a very high level, what we're dealing with investing are financial instruments, which break down into a number of categories. The ones you're most familiar with, of course, everybody uses cash checking, savings, and certificates of deposit, which are used much less frequently now. They're basically savings accounts. This stuff together is what we call money. So when you hear economists or financial analysts referring to money, this is what they mean. It's not just cash, it's the checking, it's the savings, it's certificates of deposit also. Then bonds, which we'll refer to as debt, stocks, which we'll refer to as equity, and then futures and options contracts, which are called derivatives. They're called derivatives because they derive their value from stocks principally. So they're contracts that will enable you, in which you agree to purchase or sell stock at some point in the future. I'm going to be focusing mostly on bonds and stocks here. So a bond, of course, you know, is simply a legal contract in which one party promises to make payments to another. And what's interesting with bonds is that the interest rates are never stated. Now, you'll hear it in the news. People will say, you know, the interest rates on bonds are going up or going down, but they're not actually stated in the contract. Rather, what you see in the contract is something like this. IBM promises to pay you $1,000 on January 1st, 2025. This is the contract, and you pay something for this contract. So they put it out there for sale. It's auctioned off. And let's suppose this contract sells for $900. Well, then what's happened here is you pay $900 for this contract, you walk off with it. 5 years later, you come back, you hand it to IBM, they give you $1,000. So implicitly, you made a $100 return. You paid $900 for it, you get $1,000 back. You made a $100 return on a $900 investment. So 100 divided by 900 is the implicit rate of return on this bond. And then notice something interesting. If the price of the bond falls, so let's say it falls from 900 to 850, well, the bond pays you $1,000, but if it costs you $850 to purchase the contract, then you're paying $850, getting $1,000 back. That's a $150 return you're making. So as the price drops, you actually make more of a return. So this price and return move in opposite directions. So this is one of the things that you'll notice now, well, it's kind of ending now, but for the past 20, 30 years or so, we've had remarkably low interest rates in this country. And the interest rates have been remarkably low, principally because the Federal Reserve has been buying up bonds, mostly treasury bonds. They've been purchasing bonds. And if you've got somebody in the market purchasing a tremendous amount of bonds, what does it do to the price of bonds? It drives it up, just like it would drive up the price of anything else. If you went to the market and started buying up all of the lumber, the price of lumber would start to rise. So too here, the Federal Reserve moves into the market, starts buying up bonds, it pushes the price of bonds up. And what do we know? The price and the return move in opposite directions. So as the Fed pushes up the price of bonds by purchasing them, it pushes down interest rates. So these two things move in opposite directions. So when you think about bonds, there's a variety of flavors, but the two basic flavors are simple bonds, which is what I've described. It's a straight up contract. I promise to pay you some money in the future. You pay me some money for this contract. Bonds that are more common are called coupon bonds. And coupon bonds have this extra piece to them that it works like the simple bond, that you pay me money for the contract, you get the contract. At the end of the life of the contract, I'll give you your money back, or whatever it says in the contract I promise to pay you. But then in addition, you'll get these extra payments. We call them coupon payments. And you can say it here, IBM promises to pay you $1,000 on January 1st, 2025, plus 1% each January 1st. So if you think about how these things work, with the simple bond, if you picture a timeline, and suppose today is January 2020, you pay $850 for this thing, and then you walk away. Nothing happens until January 2025. When you come back to IBM, you hand them the bond, they give you $1,000. So that's the cash flow for a simple bond. For a coupon bond, January 2020, you pay $850 for this piece of paper. And on January 2021, IBM will cut you a check for 1% of the value, the face value of the bond, 1% of the 1,000, so $10. And on January 2022, again, IBM will cut you a check for 1% of the face value. So you get a check for $10, 1% of 1,000. And this keeps going on and on. January 2023, January 2024, these are called coupon payments. So every year you're getting this little bit of money from IBM. And then finally, on January 2025, the bond has now reached the end of its life. So you get this regular coupon payment of $10, plus you get the $1,000 that IBM promised you at the end. These simple bonds tend to be more common with governments. Governments will issue simple bonds. Corporations tend to issue coupon bonds. And so because there tend to be more trading in corporate bonds as a whole, you'll tend to find more bonds out there of this second type, the coupon bond. Now here's the thing. Returns, as you know, come at a cost, and the cost is risk. Risk is uncertainty about the return. So I give you a couple of examples here. We've got two stocks, a share of stock in ABC Corporation, a share of stock in XYZ Corporation. In both of these shares of stock, each of them sells for $50. So $50 will buy ABC, or $50 will buy XYZ. Now here's the thing. Let's suppose there's a 50% chance that come tomorrow, the price of ABC stock will have risen to $55. And there's a 50% chance that come tomorrow, the price of ABC stock will have dropped to 45. That is, there's a 50%, if you buy ABC stock today, there's a 50% chance that you'll gain $5. There's a 50% chance that you'll lose $5. Now look at XYZ. For XYZ, there's a 50% chance that come tomorrow, the stock price will have risen to $60. And there's a 50% chance that come tomorrow, the stock price will have risen to $100. That is, if you buy today this share of XYZ, there's a 50% chance that come tomorrow, you will have made a $10 profit. And there's a 50% chance that come tomorrow, you'll make a $50 profit. So here's the question. Which of these two stocks is more risky, ABC or XYZ? And this is a question I put to my principal's finance students, and invariably, probably 80% of them answer the question incorrectly, which Keshem has just done. ABC is not the more risky stock. I'll show you why. Look at ABC. There's a $10 range of uncertainty as to what's going to happen. There's a 50% chance that the price will go up to 55, you'll make a $5 profit. There's a 50% chance it'll drop to 45, in which case you make a $5 loss. There's a $10 range of uncertainty. But look at XYZ. There's a $40 range of uncertainty. So of the two, you're more uncertain about what's going to happen with XYZ. XYZ is the more risky stock. Now, let me ask you a different question. which stock would you rather buy, ABC or XYZ? And here, everybody's going to say, I'd rather buy XYZ. And I ask you why. And you say, because XYZ is a guaranteed win. There's a 50% chance I'm going to make a 10% gain. There's a 50% chance I'm going to make a $10 gain. There's a 50% chance I'm going to make a $50 gain. I can't lose with XYZ. With ABC, I could possibly lose. I might make a $5 gain. I might make a $5 loss. And Sajnik has said the right thing. It depends on what risk you're willing to put up with. So what's going on here is, as you think about your decision to buy one stock versus the other, there are two factors involved here. One is the risk, the other is the expected return. If you look at the risk alone, XYZ is the riskier stock. There's more uncertainty there. But the return on XYZ is guaranteed. In fact, it's so much higher than the return on ABC that virtually everybody is going to say, yeah, I want the XYZ stock. So what you have done as you say to yourself, I want the XYZ, you have balanced risk against return. And you've said, okay, there's more uncertainty. I'm less certain of what's going to happen with the XYZ. I might be up 10 bucks. I might be up 50 bucks. There's $40 worth of uncertainty. But that uncertainty is worth the return because it's a guaranteed, it's going to be a plus 10 or a plus 50 versus a plus or minus 5. So you weigh the risk and return. If the return is worth the risk, then you purchase this stock. If the return is not worth the risk, then you don't. Now, go back to this idea of the stock. So we've got IBM, he's over here. This is IBM looking to sell this bond, and the bond is risky because there is some chance that IBM might go bankrupt, it might be into default, that it won't pay back the bond, right? So there's some risk associated with this bond, but the bond also generates some sort of return. And then we've got you standing over here and you've got cash in your pocket. The cash is safe. That is, it's $100. You can put it under your mattress and come back next year and pull it out and it's still $100. But it generates no return. It's just $100. So when you purchase this stock from IBM, actually two things have changed hands. One is you're going to be getting some return because now you have this bond. But the other things that happened is that you've taken on the risk. When you purchase this bond, that risk is now in your pocket. What happened to the $100? The $100 you handed to IBM, and the $100 does not have risk. So you have quite literally removed risk from the market by purchasing this bond. All right, now let's take this idea of risk and return and turn our attention to stocks. So a stock, unlike a bond, is not a legal contract between you and the company. It's simply a certificate of part ownership. You are now a part owner in this corporation. And how do you make money with stock? Well, you know this, it's capital gains and dividends, right? So you buy low, sell high, and you make some profit there, that's capital gains, or you hang on to the stock, and as the company makes profit, some of that profit gets sent to you because you're a part owner, and we call that dividends. Stocks, of course, are riskier than bonds because there's no contractual relationship between you and the company. If I buy a share of stock in Walmart, Walmart is not guaranteeing that I'll get anything, right? It's not even guaranteeing that I'll get dividends. Whether the company pays dividends is up to the board of directors. They may choose to pay dividends to their stockholders, or they may choose not to pay dividends to the stockholders and instead invest the profits into expanding the business. So there's no guarantees with stock, unlike with a bond that's a legal contract and it says IBM promises to pay you this $1,000. So the stocks are more risky. Because of that, they'll tend to have a higher return. So typical return, of course it varies, right? The typical return on bonds, you can figure around maybe 5 to 7% in that range. Typical return on stocks, you can expect maybe 8 to 15%, maybe 8 to 12%, somewhere in that range. So more return coming with the stock, but it comes at a cost. The cost is the stock is riskier. So if you look up information on a stock, you'll see something like this. And if you've messed around with investing, you've probably seen screens like this. This is Walmart. And what you see here, of course, is Walmart and Walmart's ticker symbol, WMT. So every stock has a ticker symbol that uniquely identifies it. There's an interesting story about ticker symbols. There's AT&T some years back, and AT&T, of course, you know, today is a wireless company. The original AT&T was a huge conglomerate, and had some good news, and so AT&T's stock would go up. Now, here's the thing: AT&T's ticker symbol was T. So, you know, if you hear the good news about AT&T and you want to buy into their stock, you go and you look up the ticker symbol T and you buy the stock. But here's the interesting thing: there was some small company that did something, I don't even know what it did, but it was some minor corporation whose ticker symbol was ATT. On that day, when AT&T announced whatever this good news it was, this tiny little company's stock went through the roof because a bunch of investors mistakenly thought the ticker symbol ATT stood for AT&T, and they bought into this tiny little corporation, driving up its stock price. So every stock has this ticker symbol. You see here the price. At the time I took this screenshot, Walmart was trading at $145 a share. That's down 25 cents from the previous day, which is 0.17%. You can see some information about over the past year, the past 52 weeks. The price of Walmart stock has ranged from a low of 102 to a high of 153. So this price that you're seeing right now, 145, is closer to the top end of the range of where Walmart has been over the past year. Volume is the number of shares that have been traded typically on a daily basis. So you see here on a daily basis, Walmart, there's about 3.2, 3.3 million shares of Walmart stock traded. This actually becomes important because one of the things you have to be careful with if you're investing in stocks is that you don't get stuck in a stock that has small volume. For example, suppose there's the minor company I was telling you about before that had the ATT ticker symbol. And so I buy this stock of this small company, and you say, well, it's no big deal. You bought the wrong company, just sell it. Well, here's the problem. If there isn't a large volume of trades, and there are some stocks that only trade maybe, a few hundred shares a day, I may actually have a problem selling this stock, particularly if a bunch of other people are trying to sell it as well. I can go to the market, attempt to sell this, and there are simply no buyers because the market isn't interested in buying the volume of stocks that people are looking to sell. So one of the things that you look for in a stock, if you're being careful, is, I want to invest in a solid stock. You look at the financials and all this stuff, but one of the things you look at is the volume. You want a stock that has lots of trades going on so that you're comfortable that if tomorrow you decide to sell this thing, there'll be a buyer out there who's willing to buy. The beta, and I'll talk a lot about beta in a minute, but the beta represents the riskiness of the stock. There's a technical way we go about calculating this thing, but it comes up, you get this number, represents how risky the stock is. And the beta ranges from, think of it as from 0 to infinity, where a beta of 1 is a stock that is as risky as the market as a whole. So as you think about risk here, remember what probably matters to you more is not the inherent riskiness of the stock, but rather how risky is it relative to my alternatives. Your alternative here is the market as a whole. So a beta of 1 means your stock is as risky as the market as a whole. Beta above 1 means the stock is more risky than the market, and a beta below 1 means it's less risky. So here you've got Walmart at 0.44. So Walmart, this is significantly less than 1. Walmart is much safer than the market as a whole. And then here you have, finally, we talked about the company paying you dividends, and you can look up here and see that the last time the company paid dividends, it paid $2.16 per share, and that's a return of about 1.4, almost 1.5% on the stock price. Okay, so you see about bonds, you see about stocks. Now, here's the important thing. What you care about as an investor is not the return or the risk of a particular financial instrument, but rather the overall risk and return of your portfolio. So for example, let's suppose that you have a portfolio of these stocks. Now, an actual portfolio would have not just stocks, but bonds in it as well, but we're going to make it simple. Let's look at a portfolio of just these 2, 4, 6, 7 stocks. So you got 2 shares of Dell. That Dell currently is $60 a piece. So those 2 shares are worth $120. 2 shares of Twitter worth $90 total. 2 shares of Exxon worth $120 total, and 1 share of Zoom worth $190. So you've got a portfolio of $520 worth of stock. Now, let's suppose that between now and next month, the price of Dell goes up by 1%. So now you've got not $120 worth of Dell, you got $121. And let's suppose that the price of Twitter drops by 3%. So you've got not $90 of Twitter, but you've got 87. And the price of Exxon goes up by 4%, and the price of Zoom goes down by 2%. So you got some of your stocks going up and some of your stocks going down. One of the errors that investors will make at this point is looking at, for example, Twitter and saying, look, well, Twitter's down 3%. My other stocks are up. Well, Zoom is down 2%. I need to get rid of Twitter. You're micromanaging your portfolio. You're thinking about it in terms of the individual stocks, which is not what you should be thinking. You should be thinking in terms of the portfolio as a whole. Your portfolio as a whole hasn't changed. So yeah, your Twitter is down, your Zoom is down, but your Dell is up and your Exxon is up. And so your portfolio that was worth $520 last month is still worth $520 today. It's the portfolio that matters, not the individual stocks. So let's go back and think about this beta for a moment. You can look up, these are the actual betas for these stocks. Dell's beta is 1.2, Twitter's 0.7. Zoom's is actually negative. I'll talk about Zoom's in a minute. But here's what the beta means. Here you have Twitter, and Twitter with a beta of 0.7. And as you look at this is the stock price for Twitter. That's in the blue, going from left to right. So February 2017 up to the present. You can see it going up and going down, going up and going down. And SPY is the S&P 500. So think of that as measuring the market as a whole. So you can see the gray line, the SPY, the market as a whole goes up, it goes down, goes up, goes down, this kind of a thing. And you can see Twitter moving along, not moving in lockstep with SPY, but kind of moving in the same general direction. Now look at this. That movement, that monthly movement, is the typical change in SPY. It's a typical change in the market as a whole. Now, of course, you can see sometimes it's more, sometimes it's less, but what I'm showing you there is the average monthly movement in the market as a whole. This is the average monthly movement in Twitter. Now, of course, sometimes it's more, sometimes it's less, but that's the average monthly movement in Twitter. And what do you see? That average monthly movement in Twitter is about 70% of the average monthly movement in the market as a whole. That's the beta. This plus or minus movement in Twitter on average is about 70% of the magnitude of the plus or minus movement in the market. Twitter is actually less risky than the market. There's less movement, less uncertainty with Twitter than there is with the market as a whole. Let's look at Exxon. Exxon's got a beta of 1.4, so this is riskier than the market. So there's more movement in Exxon. So here again, you can see typical monthly change in the market as a whole, the SPY, and the typical monthly change in Exxon. And the typical monthly change in Exxon is about 140% of the typical monthly change in the market as a whole. So on average, if the market as a whole is going to give you a plus or minus 3% movement over the course of, let's say, a month, then you can expect Exxon to give you a plus or minus 1.4 times 3% movement over the course of that same month. Exxon's going to move by more. Now, notice something important. I'm not saying that one's going up and one's going down. This is simply a discussion of the magnitude of the movement, whether it be up, whether it be down. What's the uncertainty? Now here's Zoom. And Zoom's beta is negative 1.2. So the first thing you notice is the typical change in Zoom stock is 120% of the typical change in the market. So Zoom's going to move by 1.2 times what the market moves. But what about that minus sign? The minus sign indicates that unlike Exxon and Twitter, Zoom typically moves in the opposite direction of the market. Not all the time, but on average, when the market goes up, Zoom goes down. On average, when the market goes down, Zoom goes up. That's the negative of this beta part. So the magnitude of the fluctuation is 120% of the fluctuation of the market, and it's negative, meaning that Zoom is moving on average in the opposite direction of the market. So if you think about this, notice something interesting. Here's Exxon and Zoom together. And Exxon, you know, has this riskiness. It's a beta of 1.4. So it's, uncertainty moving up and down. And Zoom has a riskiness of 1.2. It's uncertainty moving up and down. But Exxon's beta is positive and Zoom's beta is negative. That is, if you put these two stocks together into a portfolio, the ups on Exxon will tend to cancel with the downs on Zoom. Let me show you how this works. So here again is your portfolio, and you've got the betas for each of these stocks. The beta for your portfolio is 0.3. Now let that sink in for a minute. The riskiness of your portfolio is actually less than the riskiness of each one of the stocks in the portfolio. You can take these 4 stocks, each of which have a certain riskiness, and when you put them together into a portfolio, the portfolio itself has less riskiness than any of the stocks. This comes about because the stocks will have, to a greater or lesser degree, a tendency to cancel each other out. The up movement of one will tend to cancel with the down movement of another. So what happens with investment is we make use of this fact that the ups of some stocks can cancel with the downs of other stocks, so that when you put them together, you can benefit from the average expected return, while at the same time eliminating the risk, not eliminating, but reducing the risk as the ups of one cancel with the downs of the other. What we're looking to do here, this thing I just described, is to create what we call an efficient portfolio. An efficient portfolio is a portfolio of stocks that gives you the greatest possible return for a given level of risk. Let me show you an example. So here I've got a bunch of dots, and each dot is a different portfolio of stocks. And as you think about different portfolios, think about this. So I showed you an example of Zoom and Exxon and Twitter and whoever the other guy was, Dell, those 4 stocks. I could swap out Dell for Walmart and I have a different portfolio. I can swap out Exxon for Southwest. I have a different portfolio. So I have different portfolios. But you can get different portfolios not simply by swapping out the stocks, but by changing how much of the stock is in the portfolio. So for example, I had 2 shares of Dell, 2 shares of Twitter, 2 shares of Exxon, and 1 share of whoever the last guy was, Zoom. If I got rid of one of the shares of Dell and purchased in its place an additional share of Exxon, I'd still have the same $520 in my portfolio, but I now have a different portfolio because I altered the mix of the stocks. So different portfolios can mean different stocks, but they can also mean different mixes of the same stocks. So you look at these dots, each dot is a different portfolio. And on this graph, as dots that move to the right, they represent greater risk. This is the risk of the portfolio. So portfolios to the right are riskier, portfolios to the left are safer. The up and down is the expected return of the portfolio. So the higher the dot is, the greater the average return on the portfolio. The lower it is, the lesser return on the portfolio. So take a look at this interesting thing. Let's suppose we pick a level of risk, and the level of risk we have is 1.2. So I want to build a portfolio of stocks that has a beta of 1.2. Not that the stocks have 1.2 beta, but my portfolio, after I put everything into it, the portfolio has a beta of 1.2. There are a whole bunch of different portfolios that I could construct that have a 1.2 beta. In fact, any portfolio that falls along that dotted line would have a beta of 1.2. But what's interesting is, look at this. There's one portfolio along this 1.2 beta line, and that portfolio has an expected return of 5%. So if I had that portfolio, I've got a risk of 1.2, and on average, I should get a 5% return. Sometimes more, sometimes less, on average 5%. Look at that stock, or excuse me, look at that portfolio. That portfolio has the same beta of 1.2, but it has an expected return of 7%. So that second portfolio is superior to the first one. Why? It has the exact same risk that the first one had, but it yields a greater return. That second portfolio we call efficient. It is the efficient portfolio for portfolios with a beta of 1.2. Now you could imagine doing this same thing and say, show me all the portfolios that have a beta of 1.1. Now, of all these portfolios with a beta of 1.1, which one has the greatest expected return? That's the efficient portfolio for a beta of 1.1. And you do this for all of the betas, and what you end up with is that curved line that you see there. We call it the set of efficient portfolios. The goal of portfolio management is to find that thing. That's where you want to be investing. Anywhere on that curve, you're getting the greatest return for a given risk. Now, here's a question. How do I know what level of risk I want? That question doesn't have a set answer, because the level of risk you want is a purely subjective thing. Some of you have more tolerance for risk, some of you have less tolerance for risk, and your tolerance for risk will change. When you're 16, 18 years old, your tolerance for risk should, particularly in the stock market, should be incredibly high. As you age and you're approaching retirement, your tolerance for risk should get smaller. As you're into your retirement years, your tolerance for risk should be very low. What we do with this set of efficient portfolios, we call it the efficient portfolio frontier. What we do is we say, okay, we found this set of the best portfolios for each level of risk. Now tell me what your level of risk is, and I'll tell you what portfolio you should be investing in. So you, as the person who's putting the money on the table, you say, this is how much risk I'm willing to take on. Your portfolio manager then says, given that you want that level of risk, here's the efficient portfolio. And so you put your stuff in there. Now, all of this, well, I don't want to say it sounds simple. As complex as this might sound, I've drastically simplified it because the number of possible portfolios, so you see those blue dots on the screen here, the number of possible portfolios exceeds the number of atoms in the known universe. So finding that set of efficient portfolios is, I was about to say a difficult task. More than that, it's an impossible task. What you'll do is you'll get really good financial managers who find more efficient portfolios than other people can find. And you'll have poor financial managers that can't find as efficient portfolios as other people can find. But the odds of you finding the absolute most efficient is probably near zero, given the number of possible combinations are out there, and given the fact that the attributes of these stocks are constantly changing. So that's a very long-winded way of saying, as you think about investing, this is something that by all means you should play around with. It's a great way to learn about stocks and bonds. It's a great way to learn about investment, but don't on your own invest any money that you aren't prepared to lose, because doing this well is incredibly difficult and incredibly complex. There are people who go and get advanced degrees that figure out how to do this, and you hire them to do it for you. We're running low on time. If you've enjoyed this, I'll give you a shameless plug for my podcast, Words and Numbers, where we talk about stuff like this. But we've got a couple minutes. If you have questions, you can put it in the chat box. Keshem is asking, what's a good way to curate a stock and bond portfolio so that you could be financially independent at a young age? There isn't a good way to do it. As I've shown you here, this is not something you want to do with serious money. If you're looking to be financially independent at a young age, here's the formula I'd give you. First thing is save as much as you possibly can. My rule of thumb for saving is start at age 18 and save 15% of everything you earn. Whether it's high or whether it's low, doesn't matter. 15%. Start as soon as you can, but certainly no later at age 18. When you get up to roughly 10,000, just put this money in a regular savings account, right? When you get up to roughly about 10,000, and that won't, it sounds like a lot, but it won't take you that long. Maybe 5-7 years. It'll take you to get to about $10,000. When you get to that level, then you've got enough that a portfolio manager will deal with you. Less than that, and you don't have enough money for it to be worth a portfolio manager's time. So you go find a portfolio manager and you say, all right, now I'm going to be giving you my money, 15% of every paycheck I'm going to be sending to you. I want you to invest it invest it in however it should be invested. And the portfolio manager will sit down with you and ask you questions to try and get an idea of your risk tolerance, right? So if you picture that graph, where on that line of betas you're willing to be. And then the portfolio manager will handle this for you. And you don't touch this until you retire some 60 years into the future. And if you do what I just described to you, you will retire, even adjusted for inflation, you will retire a multimillionaire. Any other questions? Casey said it depends, how you invest depends on time and how much risk you want to take. Yeah, the risk is absolutely true. The time, it does depend on time, but not as much as you would think. Being your age, your time horizon should be really long. You should be looking to retirement, right? And you probably don't need to start thinking about time until you hit, I'd say, age 55. You hit age 55, you're getting close enough to retirement that now how much time there is between now and retirement begins to matter. Because here's the big thing with the time. The longer time horizon you have, the more able you are to weather deep recessions. So the stock market crashes and everybody loses 30% of their money. If you've got a 30-year time horizon, that doesn't matter. The stock market's going to come back. If you've got a 5-year time horizon, you may have a problem, because I don't think a stock market can come back from a dip like that in a 5-year time span. But in a 30-year time span, certainly it can. So I wouldn't worry about it. Would I consider NFTs an okay thing to do? In my personal opinion, I consider NFTs like cryptocurrency, an absolutely fun thing to mess around with it. Do not take it seriously. Do not put serious money into it. As with cryptocurrency, you could make a tremendous amount of money. You could also lose a tremendous amount of money. It's not for serious investing, at least not for the present. In 20 years, it might be. And again, I want to underline something. For all the warning I'm giving you about investing, I would encourage you to do it. Get the Robinhood app and mess around with cryptocurrency, invest in stocks, because it's tremendous fun. You might make some money. You'll learn a tremendous amount, but do it with money you can afford to lose. Don't do it with your serious saving. Treat it not as an activity in investing so much as an activity in education. What are the parameters for serious investing? Keshem, if the money you're dealing with is money that you intend to use for something, for retirement or for purchasing a home or purchasing a car, that's serious investing. If it's money that you would regard the same as money you would take to a casino, that maybe you'll make something, maybe you won't, it's just going to be fun, that's the not serious investing. How much money do I suggest you start investing with? Yeah, if you're talking about serious investing, again, a portfolio manager isn't going to deal with you if you've got less than 10,000. So what I would do is start putting money away in a regular savings account, not in the stock market, just put a regular savings account till you build it up to 10,000. Then go find a portfolio manager. Malik is asking, what is my point of view about investing in such brands? What brands are you thinking about, Malik? Oh, Nike mostly. Yeah, so you're asking me a question I can't answer. That's a question for a portfolio manager, right? Someone who makes it their full-time job to study these things. What I can tell you is this: when you run across news that indicates that a company is doing well, it's going to make a good investment, you're too late already. Because there are many more people who have access to the news faster than you do that have already moved in and done whatever, invested in this thing. What I tend to do if I'm doing not serious investing, what I'll tend to do is look at products that I like. So I started using Zoom a long time before COVID, when it was a little company nobody ever heard of. Unfortunately, it wasn't a public company, so I couldn't invest in it. But that's the sort of company I would have invested in had I had the ability, because it's something that I was using. I like it. It's got good quality. And if that's the case, this is likely a company that's going to do well in the future. So if you want to think about individual brands, you may think about it in that context. Think about your personal experience. What do you use? What products do you find useful that you think other people might find useful also? Anyone else? Casey, should you invest in multiple stocks, not just one? Okay, Casey. So again, let's talk about not serious investing. So this is just play money. You just want to play around, see what's going on. What I would do, the first thing, is look for individual stocks. And my rule of thumb is to look for what are called value stocks, V-A-L-U-E, value stocks. Value stocks are stocks that are underpriced. So they're stocks in that maybe they've taken a beating because maybe there was some bad news about the company. But if you look at it, generally the company is it's solid. It had some bad news, some setback or something. So the stock price tanked. That's the time to buy. In fact, what you're doing here is the opposite of what many people do, because when they see a stock price tank, they say, oh, I got to get out of here. That's a horrible stock. But notice something. That's the exact opposite way you buy everything else, right? If you're looking to buy a pair of Nikes, right? Malik wants to buy a pair of Nikes. What's he going to do? He's going to look around for the lowest price possible. If somebody has a sale on Nikes, he's going to go buy them. He's not going to look around for the highest price possible. And yet somehow that's what we tend to do with stocks. We look at the high prices and say, well, that's a good stock. And the low prices, we say, well, that's horrible, and we get out. So what you want to do with value investing is look for the stocks that have tanked, not only tanked, but stocks that have tanked, but that are fundamentally solid. So they've got, they're not in a lot of debt. They've got good financials. They've got, a solid product. They just had some bad news that came along, and you can see them doing well in the future. That's the kind of ones I would go for. So I do that first. And then second, you want to buy multiple stocks. Now you can start playing around with these positive and negative betas. So maybe I invested in Exxon first, and then I see Zoom, and Zoom's got a negative beta. Exxon had a positive beta. So I buy the Zoom also. And now I've got this synergy going on where the ups of the Exxon counteract the downs of the Zoom, right? And you can play around with that. Anyone else? Keshem, I'm glad you think it's interesting. Well, I guess most people find this thing just boring, but I guess the bunch of you are because you're part of an investing group, you're atypical in that fashion. I also think it's intriguing. It's a fascinating thing. One of the things that you notice as you start messing around with this is you come to appreciate what investing is about, which many people don't. So they look at people like Elon Musk, who has billions of dollars, and they say, well, what did he do to get that billions of dollars? And it's not right that he has this billions of dollars. And when you start to understand investing, you start to understand a couple things. The first thing is he doesn't have billions of dollars. He has billions of dollars worth of stock, but that's a different thing, right? He's just not sitting on cash. He's sitting on the stock. And furthermore, what's he done? He's taken on gargantuan risk to build this company that employs all sorts of people, that's producing products that are going to help other people. And when you start to mess around with investing, you start to see the other side, that the multi-billionaires who are sitting on all this money, or sitting on all this stock, have actually contributed a tremendous amount to the rest of society that those of us who don't mess around with investing tend to forget. What's the best age to start investing? The best age to start investing seriously, so putting the money aside and you're going to give it to a financial manager as soon as possible, as soon as you have a job, even if it's a part-time job, minimum wage job, doesn't matter. Start saving 15%, start putting it away. If you want to start playing around with not serious investing, I think probably the ages that you're at are about right. When you start asking questions like, what is stock, what is bonds, what's a beta, what's a return, start playing around. Just, again, play around with small amounts of money that you can afford to lose. Anyone else? Okay, thank you all for being here. This has been wonderful. Arminta, thank you for having me.
Okay, great. Thank you so much for your presentation and also answering everyone's questions. So yeah, again, thank you.
Thank you.
Okay, everyone. So that concludes the last portion of today's event. But before you leave, I do want to send the feedback form in the chat. I want everyone to fill this out because this is what we will be using to create your certificates that we are going to be filling out, as well as additional information that we are going to send after the event. So I'm going to send that in the chat and play some music. And please make sure to fill that out before you leave. And again, thank you so much for participating in EmpowerEcon's event.
you.